Hello, I'm Aaron Bates. Welcome to our August 10th episode of The Lounge. Today I have with me Ryan Gilmer. Ryan is an investment advisor with Whitcomb Hess, and part of Ryan's primary responsibility is selecting mutual funds from the mutual fund universe that end up making it into investors' portfolios. So today we're going to talk with Ryan a little bit about how he goes about doing that. Welcome. Ryan, I just wanted to talk a little bit about this article that was in the Wall Street Journal this week about how low fees outshine the STAR system. And for our viewers, can you talk just a little bit about the STAR system and how it's developed by Morningstar, and then also talk about why they are saying that low fees are a better predictor of future success than the STAR ratings themselves?
Sure. Well, the STAR system was developed by Morningstar, where they rank every mutual fund on a scale from 1 to 5, with 5 being the best or most desirable ranking and 1 being the worst. And they take a look at the performance of funds going back, so how well did the fund do compared to its benchmark, and then also was there more or less risk taken in terms of maybe standard deviation or some other methods. Was there more or less risk taken to get that performance? So what you do is you kind of have risk in one hand and return in the other, and you kind of put both of those together and say, okay, what were the risk-adjusted returns? And then the best funds get higher rankings. The either the riskier funds or the underperforming funds get lower rankings. So that's generally the STAR system is really just looking at the past. What's happened? What funds got an A, B, C, D, or F? I guess you could look at it that way. So,
and what does net expense ratio of a mutual fund? What impact does the expense ratio really have on a mutual fund?
Well, the expense ratio is the cost to the investors in a fund for the fund's management, its research, its overhead, all the costs to run the fund. Investors bear those costs. So if a fund returns 10% on average for a year, and the expense ratio is 1%, then the net return to the investors is 9%. So obviously, all things being equal, you want to keep your investors want their expense ratios to be lower, because then they can keep more of the performance. So the expense ratio is important. It's a factor in how much return the investor sees at the end of the day from the manager.
So, sharing that, then, am I to believe that automatically the lower the expense ratio, the better the fund?
I think that's not a leap we're willing to take. The article, states that on average, all things being equal, a lower cost fund will outperform a higher cost fund, which makes sense. If a fund returns 10% and has a 0.5% expense ratio versus a 1% expense ratio, obviously you'd rather have the fund that has a 0.5% expense ratio. But if a fund like a Vanguard fund has a small expense ratio, let's say the Vanguard fund earns 10%, but its expense ratio is 0.1%, so the net return to the investor is 9.9%. Well, let's say another fund's out there that makes 14%, and it charges a 2% expense ratio. Well, the net return to that investor is 12%. So after fees, the higher expense fund did better than the lower expense fund, which, again, the article says that on average that's not the case. But expense ratio, as just looking at expense ratio, doesn't tell you, if a fund should be, accepted or rejected or used for our clients or not used for our clients. As long as expense ratios are in some acceptable range, in general, they don't have as much impact on the fund's performance, or at least it's the manager's skill is able to overcome the higher fees. So
at the end of the day, it's really about what net return does the investor get, and not necessarily what's the expense ratio that determines that.
That's the way we view it. And just because a manager had superior performance in the last 10 years doesn't mean he'll do that in the next 10. So again, we want to have low expense ratios. We don't want to simply buy expensive funds just because. Right. So we look at it. It's something that's very important, but we're willing to pay a reasonable expense ratio for great managers rather than a low expense ratio for market return.
Are there certain types of funds that have like a different range of expense ratio? I mean, are there some types of funds that have traditionally high expense ratios versus other funds that have traditionally low expense ratios? Or, I mean, how does that go into your research that you're doing on the investments?
Generally, bond funds would have lower expense ratios because there are lower transaction costs with buying bonds. There's just less need for the fund to have there's a smaller universe of bonds, maybe there's less research needed, that kind of thing. Also, bond funds are going to return less, so it's important to keep the expense ratio reasonable so that the investors get some return at the end of the day. A fund that requires more research, let's say foreign stocks, if you're going to do research on companies in Japan or China, it takes more commitment, more capital to do that. Small cap stocks might have higher expense ratios. In general, a bond fund might have an expense ratio between 0.5%, 0.75%, somewhere in there. A stock fund might be from 1 to 1.5%, somewhere in there. Again, within a reasonable ratio, but generally stock funds have higher expense ratios than bond funds do.
So, I guess to wrap this segment up, we would start, generally speaking, with a star rating. I mean, 4-star, 5-star, 3-star, something that's appropriate. Once the expense ratio is determined to be appropriate for that investment, what's then kind of the next level of investigation that we do on a particular fund?
Well, we want to see what the strategy of the fund is, how they go about investing, what do they do, how do they get to the performance that they've gotten to in the past. Is it a fund that can only invest in large U.S. stocks? Is it a fund that can invest only in corporate bonds? Is it a fund that can go anywhere in the world and invest in whatever it wants to? Those are all things we look at to try and figure out as best we can what the future might hold. So we want to make sure that the manager has a strategy that he's using, that he uses consistently, whether the market is up, down, whatever. And then we try to evaluate the strategy to see if it's a good strategy, does it make sense to us, is it logical, and then can the manager actually implement it? Is he successful in doing what he says he's going to do? So that's obviously that when you're trying to predict the future, you're not ever going to hit it exactly, but what's the probability that the manager can continue to give strong performance to the fund? And if we think there's a good probability of that, then we're pretty willing to start using it for our clients.
Sure, very good. Well, thanks, Ryan, for joining us today. Thank you for watching, and we hope you have a great day. And tune in next time for another episode of The Lounge. Thank you.